Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about HUYA. HUYA Inc., listed on the NYSE, is really one of the most critical and I think polarizing case studies in the Chinese ADR market right now. It's a stock that is it's defined by this profound market skepticism, which, exists despite this immense financial strength. The balance sheet is just screaming value.
It is, yeah. It's a paradox, but it's one I think the market is correctly solving. I mean, we saw that significant price weakness leading into the end of 2025, and it was really specifically driven by that November 12th Q3 earnings report. And while, sure, the company reported a modest revenue increase, the real headline shock was that drastic, 53.5% contraction in non-GAAP net income year over year.
And that sustained selling pressure has pushed the stock to trade consistently around that $2.80 mark. And that leads us to the core tension, right? Is HUYA a fundamentally undervalued capital allocation play where the market is just willfully ignoring its massive cash pile? Or, as you're suggesting, is it a structural value trap where the actual operating business is correctly priced at near zero because of, permanent margin compression?
That's exactly the question. And I'm arguing for the latter. I really believe that the regulatory uncertainty and the just structurally lower margin nature of its big strategic pivot fundamentally compromise HUYA's long-term earnings power. And that makes the cash, almost irrelevant over a multi-year horizon.
See, I come at it from a completely different angle. I see the company as a deep value opportunity that's just waiting for the market to acknowledge a really simple truth. The balance sheet arbitrage is it's too compelling to ignore.
I see why you think that. But let me give you a different perspective, and let's center it on the objective financial data. The market right now is exhibiting what I would call extreme irrationality, and it's demonstrated by the very existence of a negative enterprise value. I mean, as of September 30th, 2025, the company held 3.83 billion RMB, which that equates to about $537.7 million in cash equivalents, and deposits.
Right. That liquidity position is undeniable. We're talking nearly $500 million in hard assets. Precisely. And so if we look at the recent trading range, the market cap is hovering only slightly above this cash position, somewhere between, say, 600 and 660 million. So this means the market is effectively assigning a value of only $60 million to maybe $120 million to the entire operating business. A business that, by the way, still generated almost 1.7 billion RMB in revenue last quarter. I mean, this is a profound misunderstanding of value. And on top of that, management isn't just sitting idle, hoarding the cash. They are actively closing this valuation gap through these really aggressive shareholder return programs. You've got an ongoing $100 million share repurchase authorization, plus the significant special dividend distributions, like that massive $1.47 dividend from earlier this year.
These actions directly fight back against that hoarding cash critique you always hear about Chinese ADR value traps.
I'm sorry, but I just don't buy that the size of the cash pile overrides the quality of the earnings. Let me tell you why I think the market skepticism is completely rational. We have to focus on the compromised quality of future earnings power, that 53.5% drop in non-GAAP net income from Q3 25. I mean, this metric, non-GAAP net income, is so critical because it typically excludes all the non-cash, one-time accounting stuff, meaning this massive drop reflects a genuine, really painful decline in the core operational profitability of the business.
The steepness of the decline is concerning. I will grant you that.
It is more than concerning. It's structurally defining. This drop is the direct result of the company's, necessary pivot to game-related services, advertising, and other revenues. And while that segment did grow, 29.6%, it forced HUYA to incur these structurally higher revenue-sharing fees to its game partners and content creators. And those fees are embedded in the cost of revenues, which, surprise, jumped 9.6%. So this transition means HUYA is trading the, extremely high-margin virtual gift-tipping revenue of the past for structurally lower margin distribution and advertising revenue going forward. The market's negative reaction is a totally rational repricing of HUYA as a structurally inferior, lower margin business.
That's an interesting point, though I'd frame it differently. You're focusing on the short-term margin contraction without really acknowledging why this shift happened or the long-term benefits of regulatory stability. The pivot wasn't a free choice. It was a forced reaction to the regulatory crackdown in China, right? The one aimed at curbing excessive spending and capping that volatile, high-margin live streaming tipping model. The company successfully diversified away from that single most vulnerable revenue stream.
It was a necessary move, yes, but that doesn't make it profitable.
But it's a necessary step towards regulatory compliance and long-term stability. The total net revenues returned to a growth trajectory. They rose 9.8% year-over-year to 1.69 billion RMB. The new diversified game-related segment now accounts for over 30% of total revenue. So management is strategically positioning HUYA to survive and even thrive in this regulatory new normal. That 53.5% profit drop, look, that's the cost of achieving stability. It should be seen as a one-time reset of profitability, not a permanent downward spiral. I think we should anticipate operational efficiencies to bring margins back up into an acceptable, albeit lower, range by late 2026.
I just find that argument structurally flawed because it assumes the regulatory shift is over, and it's not. The external environment remains the single biggest variable capping this stock. The pivot was a forced reaction to avoid punitive regulatory ceilings, period. Until the company can actually demonstrate that this new revenue stream driven by distribution deals and item sales can generate profit margins that are even remotely comparable to the old model, well, the Q3 results signal that this investment phase and this persistent margin compression will continue well into next year. And that justifies assigning minimal value to the operating segment because the threat of cash burn is very, very real. And speaking of the market reaction, the persistent price weakness is driven by more than just fundamentals. It's driven by investor fatigue and, frankly, capitulation. Retail investors who once looked at these stocks with a YOLO mentality are now just selling out of resignation because the stock has failed time and again to recover above critical resistance levels, especially that $4 mark. This suggests market skepticism isn't just deep-seated, it's now systemic distrust. That negative enterprise value reflects this widespread belief that the Chinese government could, at any moment, compromise the long-term earnings potential.
I'm not convinced by that line of reasoning because the technical evidence actually disproves a coordinated attack or some kind of forced suppression. If market fatigue translated into aggressive, coordinated short selling, we would see technical signs that reflect that kind of bearish betting. We need to re-examine this whole narrative that the stock is being fundamentally suppressed.
How do the numbers not support the idea that the stock is just hated?
Well, if you look at the market microstructure analysis, it shows the off-exchange short volume ratio for HUYA hovers pretty neutrally around 35%. And what does 35% mean? It typically reflects standard liquidity provision by market makers. It's the noise in the system. It is not aggressive betting against the asset. And this is a really crucial piece of context. Contrast that 35% figure with what we see in truly distressed peers. DouYu, for comparison, showed off-exchange short volume ratios as high as 75.99% in late 2025. Now that 75% indicates active, aggressive, bearish belief and forceful suppression. HUYA simply is not under that kind of pressure.
Okay, that's a very compelling distinction. So the stock isn't being suppressed, it's just being abandoned.
Exactly. And on top of that, the cost to borrow HUYA shares is extremely low. It's approximately 0.75%. This indicates an abundance of shares available for lending, and it fundamentally removes the risk of an imminent short squeeze. The price is weak because long-only holders are liquidating their positions out of frustration, not because technical factors are forcing the price down. And this, to me, actually makes the valuation anomaly more compelling for those of us focused on the floor provided by the cash. So let's return to my core thesis. The company's corporate action is tangible proof of value and capital discipline. The company has repurchased millions of ADS, deploying over $75 million under the current authorization to reduce the outstanding share count. And we really have to dissect the mechanical effect of those massive special dividend payments made earlier this year.
Yeah, that dividend was certainly confusing for a lot of smaller investors.
It was a classic example of financial engineering just confusing the public. The stock price mechanically dropped by the dividend amount on the ex-dividend date. So many retail investors incorrectly viewed this required accounting adjustment as some bearish signal or a loss of intrinsic value, when in reality, the value simply moved from the corporate balance sheet directly into shareholders' pockets. The price afterwards is simply reflecting a smaller post-distribution balance sheet. The stock drop wasn't a failure of the business, it was just reflecting the fact that the cash had moved out of the vault.
That's a compelling argument, and it is true that the dividend's mechanical drop created a poor psychological signal. But we have to look ahead at the competitive landscape, which provides the final and I think lethal structural threat to HUYA's long-term viability. Stability for HUYA is temporary because the competitive structure has entirely shifted.
Who are they competing against now, though? I mean, Douyu is severely distressed and loss-making.
The competition has fundamentally shifted away from their gaming-focused peer to the short video giants, Douyin and Kuaishou. These platforms have overwhelming user bases, many times HUYA's 162.3 million MAUs, and they possess infinitely superior algorithmic advantages in content discovery and delivery. The market may be correctly anticipating that HUYA's current cash pile, while impressive, will eventually be entirely consumed by the high operating and marketing costs required just to compete for those MAUs in a saturating market that's dominated by these behemoths.
But management is clearly executing on returning capital before operational costs can consume it through the buybacks and dividends. They are prioritizing shareholder value right now.
They are executing, sure, but they face a ticking clock. The regulatory shift demanded a move to low-margin revenue, and the competitive shift demands continuously high spending to fight the giants. That combination, low margins and high required capital expenditure, is lethal. It proves that the $500 million cash pile is not a permanent asset, but a temporary war chest that's going to be liquidated in the battle for relevance.
I still maintain that the primary investment value here remains the balance sheet arbitrage and the capital return thesis. The market is assigning a near zero or even negative value to the core operating business while willfully ignoring management's explicit and ongoing commitment to return cash via buybacks and dividends. This provides a fundamental, tangible floor to the valuation, which will eventually be realized by investors who just have the patience to wait for these capital return programs to complete.
And I maintain that while the cash provides a floor, the long-term viability is critically compromised by that 53.5% Q3 profit drop. Until the company can demonstrate conclusively that its new high-growth revenue segment can generate sustainable and acceptable profit margins, the stock remains fundamentally range-bound. It's capped by both regulatory oversight and the superior, relentless scale of its short video competitors. The opportunity cost of holding a stock that uses its cash merely to survive competition rather than generate growth is just too high.
This HUYA case really does exemplify the complex dynamics of deep value analysis in a regulated, transforming market. The ongoing tension between a fundamentally strong balance sheet and a structurally compromised earnings quality continues to define the investment outlook. And clearly, we have much more to explore in the material as management continues to navigate this transition. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.